Chapter 16, Part 1, Temporary Tax Differences. Now, with the rules, because GAAP and tax regulations differ in a number of ways, the amounts reported for income tax expense and income tax payable will differ. Income tax expense is based on GAAP, i.e., we record revenue when it's earned, and we record expense when it is incurred and follows the revenue. For income tax payable under the revenue code, we record revenue when we receive it, not when we earn it, and expenses when we pay them, not when we actually consume them. So, temporary differences reversed over time, and examples would be estimates for bad debt. We cannot include those for tax purposes, warranties, contingent obligations, prepaid, and advance payments. We also have what we call permanent differences. These never are reversed. These are fines, and they're non-taxable transactions. Now, temporary differences. We have two types. One is called a deferred tax liability, which means we take the benefit now for tax purposes, but in the future that benefit will reverse. An example would be if for book purposes we use straight line, but for tax purposes we use an accelerated method. Now we also have what we call a deferred tax asset. It represents the increase in taxes refundable or saved in future years as a result of a deductible temporary differences existing at the end of the current year. Examples would be unearned revenue. For tax purposes, we have to treat it as revenue, but for book purposes, we do not. Or contingent liabilities, where we estimate a loss that we may occur in the future. The IRS doesn't allow you to take that as an expense until it actually occurs. Now, we use a four-step process to maintain this perspective, i.e., how do you do your journal entries? So, remember in this example, tax expense is a plug. Okay, you first calculate tax payable. This is the amount of tax currently payable based on the current year's tax income. Calculate ending deferred tax assets or deferred tax liabilities. In this step, we calculate the appropriate ending balances of the deferred tax asset or deferred tax liability. We calculate changes in the DTAs and DTLs. In this step, we determine the change because that's going to tell us what our journal entry is going to be. And then we plug tax expense. Now, that's just the way they do it in this book. I don't like plugs, but that's just my opinion. So now let's take a look at a problem and I'll show you how this works. Okay, on 1/2018, Company A purchased a $36 million piece of equipment. They used straight line depreciation for book, but for tax purposes they wrote it all off in 2018, which means they had a lot lower tax liability in 2018 than they showed for income tax expense. On December 31st, the net book value is $30 million, and on December 31st, 2021, the net book value is $28, and its tax basis is $12 million. Pre-tax income is $50 million, and the tax rate is 25%. So we start with our pre-tax income. Now, we have this temporary difference, and that's how much we wrote off for book purposes, and we have to add that back in because we've already written off 100% of this in 2018, so we can't take it twice. So we're going to add that back to net income. Now, future amount that we have is going to be 28. That's futable tax liability, and it would be 30 million minus the 2 million difference. So we're going to take it times the 25%, and so our taxes payable is 13 million, and our balance in our deferred tax liability is 7 million. Now we can do our journal entry. So we go to our T account, And we know that the difference is going to be $500,000. So our journal entry would be, first, our taxes payable, it's going to be the $52 million times 25%. Our deferred tax liability is going to go down by $500,000. And then the last thing we do is our income tax payable, which is a plug. Now let's prepare the income tax expense section of the income statement for 2021, beginning with the line income before income taxes. It was $50 million. We go income tax expense, current is $13 million. We have a deferred tax liability of $500,000, which means our net amount is $12,500,000. And so our net income for book purposes is $37,500,000. This should always total the tax per book. Now let's take a look at a deferred tax liability multiple years. So, they acquired an asset for $80 million in 2021. The asset is depreciated for financial reporting purposes over 4 years on a straight line basis. No residual value. For tax purposes, the asset's cost is depreciated by makers. The enacted tax rate is 25%. The amounts for pre-tax accounting income, depreciation, and taxable income are as follows. Pre-tax accounting income is shown, and then we show the depreciation on the income tax, depreciation on the tax return, and the difference is going to be our taxable income. For December 31st of each year, determine A, the temporary book tax difference for the depreciable asset, and B, the balance to be reported in the deferred tax liability account. So, we start with our depreciation on the income statement. Depreciation on the tax return. That's our difference. Now, as you can see, they really net out, because when you take the 5 plus the 13, that gives you 18 negative, and then you take the 5 plus the 13 when we reverse it, and that 18, which zeroes out. So remember, in the end, you still end up the same amount. You're just moving the stuff around when you're going to pay the tax. Now you take it times the tax rate, and that tells you what the deferred tax liability is for each year. Now, what about the cumulative balance? Okay, cumulative temporary book minus tax difference. Cumulative deferred tax liability. Oh, and that's our totals right there. So how do we get that? Well, we take, if you look at our deferred tax liability, well, first we look at our temporary difference is 5, and then it becomes, you add the 13, that gives you 18, and then it's reduced to 13, and then it goes down to 0. And the same thing happens, because remember, at the end of the 4 years, it totals the same amount. It's just what year it's hitting. Now let's take a look at another example, deferred tax asset. In 2012, My Corporation collected rental revenue for 2022 tenant occupancy. For tax purposes, it is taxed when collected, and for book purposes, the revenue is deferred and recognized when tenants occupy the space. The December 2012 deferred amount was $300,000, and there was no temporary differences from prior years. The income tax rate is 25%, and the income tax payable is $950,000. What is the journal? Well, income taxes payable is $950,000. Deferred tax liability is our $300,000 times 25%. And then income tax expense is $875,000. Now let's take a look at another example. Okay, a company accrues a $100 million liability at the end of 2021 based on a lawsuit. the company also has $50,000 in temporary differences due to excessive depreciation for tax purposes. Income tax before tax is $160 million, and the tax rate is 25%. What's the deferred taxes reported in 2021? What is the 2021 journal? How would this appear on the 2021 income statement and balance sheet? First, we need that $100,000. We need the $50,000. We need the $160,000, and we need the tax rate. So let's take a look at how this works. So first, what's reported? So we would have the $100 million times 25%. So remember first the accrued liability income, but not taxable income. So the excess depreciation reduces taxable income, but not book income. So we have a net tax deferred asset, because remember we always have to net them together when we look at them on the balance sheet. So we would have a net tax deferred asset. Now what's our 2021 journal entry? Income taxes payable. Our pre-tax net income is $160 million. We have to add back in that accrual, and we have to back out our excess depreciation that's over what we've done on our books. So that gives us taxable income of $210 times the tax rate, which means our taxes payable is $52,500,000. Now our journal entry. Income tax payable is $52,500,000. Deferred tax asset is $100,000 times 25% equals $25,000. And then we have a deferred tax liability, which is our depreciation times 25. And then our plug is going to be our income taxes payable. Now let's take a look at what this looks like on the financial statements. On the balance sheet, we would see under non-current assets, deferred tax asset, which is the net amount of the two. And then for the income statement, we'd see income before taxes. Income tax expense would be our current minus our deferred tax asset, which would give us $40 million. So net income would be $120,000. And again, remember, you net the deferred asset and the liability together for both the income statement and the balance sheet. And that ends this presentation for part 1 on taxes.